Hi everyone, this is Madan Ravindran. In today's video, I'll be explaining futures trading based on my experience with the real-time examples. Also, I'll be explaining about the pros and cons of trading in futures. So in this video, I'm not gonna explain much of the definitions or the concepts like I've done in the previous video. I'll be just explaining what is needed to understand, so that it will be easier for everyone to understand what exactly futures and options are. If things goes well, I'll share strategies that I have personally tried and found beneficial, along with the things that I have learned from the experts as well as the full-time traders that you won't find anywhere else on the YouTube. So I'll be posting a very lengthy videos covering all the detailed things necessary for the real-time futures trading. So please bear with me and continue watching them in the suggested order so that you can have a better understanding. So if you find my videos useful, please support my channel as well for more contents. Okay, so now let's quickly jump into the topic. Okay, let's take the current price of Nifty as an example. So Nifty spot price is 23,587. Let's quickly check what's the price of the Nifty futures. So to check that, we'll go to any of your broker and we can check for the current monthly series. So here I've opened already, so just click on buy. You can see the lot size of Nifty futures along with the margin required to buy one lot of Nifty. So for this, the lot size is 25. So 23,641 is a futures price into 25, which comes roughly around 6 lakhs. But if you observe one thing over here, the spot price of Nifty is 23,587, but the future price is slightly more than the spot price, which is 23,650, which means we can say that the futures trading at a premium price. So I have posted a separate video on why spots and futures price are not the same. I have given it in the description box. Please watch that for more understanding, because all these things are very much needed to understand before you start beginning on the futures trading. So now, as per this example, Nifty price and the margin required is around 66,000, but the value of this is around, and the margin needed for this lot is just 66k for the Nifty 50, which is just 12% of the total contract value of the Nifty. But if you see for the Reliance, the current price is but if you see for the Reliance, the current price is 1220 into the lot size is 500. That again comes somewhere to closer to 6 lakhs. But here, if you observe, the margin you need somewhere around 1.1 lakhs, which is roughly around 20% of the contract value. So from here we can see that the margin which is required for the index is comparatively lesser than the margin which is required for the individual stocks. That is because the volatility of the index will be comparatively lesser than the volatility of the individual stock. So because of that, the margin varies from stock to stock. So let me explain with an example. Now in case if we think that the market has corrected significantly at this point in time, and then you are planning to go long in the Nifty, and you are buying the Nifty futures at the current price at 23,650. Here the value of the contract, in the scenario, value of the contract will be somewhere around 6 lakhs. Let's assume that Nifty goes up by 5% in a month. So 5% of your overall contract value, which is 6 lakhs, so then your profit of 6 lakhs will be 30,000 rupees. So the same thing, if you had bought it in the cash market, your profit percentage will be again 5%, will be remain same. But in the futures market, if you see, your return of investment will be 30,000 of 67,000, which is roughly around 45% of your capital. So say for example, in case if Nifty goes down by 5%, you will again lose around 50% of your entire capital. That is why they say futures are considerably highly risky. So but it is a high risk but a high reward as well. So but the risk can be mitigated to some extent using the option techniques that I'll be uploading a videos in the future. And another important thing in the futures that will be able to understand how the margin calculation works. So this is the most challenging part for the beginners, because this is very much important to understand how exactly it works. Suppose you bought a futures contract for 65,000 today, and if the market goes down by 1%, you will need to pay the MTM losses, which is a market to market loss on the same day. So just because on the initial time it shows 65,000 as your margin doesn't mean that it will remain the same until the expiry day. So daily losses and profits will be added or deducted from your wallet. So therefore, when you're considering buying a futures, do not just have the cash that is needed for the initial purchase, but just make sure that you have surplus cash in your wallet, so that the MTM losses and the profits can be adjusted accordingly. So, though futures trading offers the potential for higher returns, but it also comes with significantly higher risk because of the leverage. So, honestly, telling from my experience, FNO trading is not ideal for anybody with less than 10 lakhs in capital. It is someone for those who are willing to take risks and also have some understanding of the market. But even though the futures are highly risky, these risks can be mitigated by using options. So that is why I always suggest learning about options before entering into the futures trading. In my upcoming videos, I'll explain how to use options to manage the risks associated with the futures trading. So from my experience, I'll list down few of the advantages of futures trading. The first advantage that I would say is the leverage that I was explaining in the whole video. So like basically that helps us to buy the futures, allows us to trade large portions with a relatively smaller margin. So for example, you can take a nifty futures long portion which is worth around 10 lakhs, but just with a margin of 1 lakh. So this leverage that you get is one advantage of future trading. And another advantage that I could say is like hedging. So most of the FIIs or DIIs or big players, they use this futures contract as hedging. So they used to protect a portfolio from adverse price movements. So for example, if you hold a large quantity of equity portfolio and you are expecting a market correction, so you can short the nifty futures to avoid potential losses. So this can be used for hedging as well, the futures. And also the another advantage that I could list is like there is no time decay. So unlike options, the futures do not lose value as they approach expiration. So which is making that suitable for the long term trades. Because if you see the options, like initially the price of in the beginning of the series, the price of the options will be more, and when you option sell it keeps going down further and further when it goes near to the expiry, so it loses the value, whereas in futures it doesn't. But in the long term trades there will be some spillovers that I'll be explaining in the disadvantage. But this is one such advantage that we have in future trading. So disadvantages of futures trading, uh, so this is like, as I already told, that this is very highly risky because of the leverage. So like this is also an advantage that I have listed in my previous slide. But so it's, if example, because of the high leverage, even the just a small movement like a just a 2% down price movement in a nifty could result in 20% loss of your margin capital, just because you have just entered only 20,000 or 1 lakh as a margin. So that can result in a 20% loss of your entire margin capital. So another disadvantage is so obligation to settle. So futures are basically just, it's a kind of an agreement that it must be settled at expiry time. So it, regardless of whether the price goes up or it goes down, or it goes on your favor or it doesn't go on your favor, in your favor. So it doesn't matter, so we have to settle it. So this is one such disadvantage. And another disadvantage that I could list over here is like complex margin requirements. Because like exchanges frequently revise margin requirements, so especially during volatile periods. So when the volatility is very high, margin requirements may spike, so which is forcing us to deposit even more additional funds. And also, like as I already told, like it's a MTM loss, market to market loss. So every day you have to keep adding your losses to, so that they don't close the, so that the broker doesn't close your positions. So and also impact of rollover costs. So this is the one place where my profits are going down, I would say. So say for example, you bought a Reliance stock at the price of 2000 rupees, and you wanted to hold this until it goes to 3000 in the future, but it may take several months. So until you get the target achieved, if you keep rolling over the contract for the every month, until your target has been achieved. So this will eat a lot of our profits. That's because, say for example, you bought a Reliance futures for rupees 2000, and consider that every month when you are rolling out to a next month, you will be losing 30 rupees. So here your loss will be 30 into the number of lot size, which is roughly around 1500. uh, so which means that you will be losing 1500 every month. So per month you are losing 1500, and in case if it takes 6 months to reach your target, so you will lose roughly around 1500 into 6, 9000 rupees you will be losing it, because of just for the rollover. uh, but there are other ways as well to get this spillover cost through options. I'll be posting a video explaining how to use options to effectively manage the risks of future trading. So please like the video if you find it useful. Thanks.